One bank sees a historic surge, a commodity soaring past $100, the foundation of a new industrial age. The other sees a dangerous delusion, a speculative fever dream about to break, and they have just drawn a line in the sand. This is not a market forecast. This is a direct challenge between financial empires. One of them is profoundly wrong, and the cost of being on the wrong side will not be measured in points on a chart, but in the collapse of portfolios and the failure of business strategies built on a broken promise. The war for the future has begun, and the first shot has been fired in the silver market. Welcome to all of you here at Wild East Stories. I am Marcus. For over 30 years, I have made my home here in Zurich, watching from this crossroads of capital as the tides of money and power ebb and flow. My work is not to predict the day's headlines, but to decipher the slow, powerful movements beneath them, the strategic games played by institutions too large for most to see in full. Today, we have a new story to unravel, one that reaches from the trading desks of London and New York into the very heart of the energy transition your business may depend on. Before we begin this journey, do an old friend a kindness. If you found your way to this quiet corner of the conversation, subscribe to the channel. It's the simplest way to ensure we don't lose each other in the noise. Tell me, as well, where are you watching from today? The comments section is always open for a proper introduction. The conflict ignited with a single research report. In the polished, data-driven language of global finance, analysts at the French banking giant BNP Paribas presented a conclusion that sent a shockwave through institutional circles. Their forecast for the price of silver was not merely cautious. It was a direct and calculated contradiction. On one side stood Bank of America, a pillar of Wall Street. For years, their analysts had championed a super bullish thesis for silver. They spoke of prices reaching 30, 50, even higher dollars per ounce. Their argument was built on a powerful narrative, the green energy revolution. Silver is a critical metal, they said, essential for solar panels, electric vehicles, and all modern electronics. As the world pushes toward a net zero future, demand would explode. Supply, constrained after decades of low prices, would crumble. The math seemed inevitable. Then, BNP Paribas said no. The French bank's model projected a different future, one where silver would not reach the mythical $100 mark. In fact, they saw it struggling to break far beyond current levels. Their reasoning was not about the distant potential of demand, but about the immediate realities of economics. They argued for technological substitution, scientists finding ways to use less silver. They pointed to thrifting, manufacturers trimming mere milligrams per device to save costs. They highlighted a harsh truth. If silver prices rise too fast, they could kill the very demand the bulls were betting on. But this is not a story about metal. This is a story about authority. When two titans of finance, with access to the same raw data, present visions of the future that are completely opposed, a deeper question emerges. It is a question every business leader and investor must ask. Who do you trust? Which model of the world is correct? For Marcus, watching from Zurich, this was not an analyst error. It was a declaration. He saw it as the opening move in a silent war. A war fought not with soldiers, but with research notes and capital allocations. The battlefield is the silver market, but the prizes are far greater. The first prize is client money. Billion-dollar pension funds, sovereign wealth funds, and private capital must choose which narrative to fund. The second prize is intellectual authority. Whose vision of the global economy will governments and corporations listen to? The third, and most critical prize, is narrative control. The story that wins will direct trillions of dollars in investment for the next decade. Is the future one of a desperate scramble for critical resources, leading to soaring prices? That is the Bank of America doctrine. Or is it a future of human ingenuity and economic pressure, where technology always finds a cheaper path? That is the BNP Paribas gambit. One of these banks has made a catastrophic error in judgment. The coming years will reveal which one. For now, the stage is set. The players have taken their positions, and the first, quiet shot in the $100 war has been fired. The only sound louder than the report is the stunned silence that followed, a silence filled with the unease of institutions realizing they might be betting on the wrong version of tomorrow. We left our story with a challenge issued, a line drawn. But to understand the weight of BNP Paribas defiance, we must first fully inhabit the fortress they are attacking. We must walk its walls, inspect its foundations. This is not about agreeing with Bank of America. This is about understanding the sheer scale and logic of their bullish doctrine, a vision of the future so compelling, it has convinced a significant part of the financial world. Only then can we grasp the audacity and the immense risk of the challenge laid before it. Bank of America's position is not a simple bet on a commodity. It is a comprehensive worldview, packaged as an investment thesis. For Marcus, analyzing it is like examining the blueprints for a grand, ambitious city promised to be built in the next decade. The primary building material in these plans? Silver. Their doctrine rests on three interlocking pillars, each presented with the cold certainty of mathematical inevitability. The first pillar is physical, tangible, and rooted in government policy. Bank of America's analysts point to the global political commitment to a renewable energy transition. The International Energy Agency, the European Union, national governments, all have published roadmaps to net zero carbon emissions. These are not suggestions. They are industrial directives with trillions in funding. And here, silver is not a passive metal. It is an active agent. There is no commercially viable solar panel without silver paste in its photovoltaic cells. The electrical conductivity in every new electric vehicle, in every piece of smart technology, relies on silver. The bank's models take these official targets, millions of new solar installations, tens of millions of new EVs by 2030, and run the numbers. The demand projections are staggering. They show a line on a graph that slopes steeply upward, far outpacing any historical precedent. This pillar argues that demand is not cyclical, it is structural and legislated. It is locked in by law and global treaty. Pillar 2, the sleeping monetary giant. The second pillar is historical and psychological. For centuries, silver was money. While that formal role ended, the memory is embedded deep within the culture of finance, particularly in the East. Bank of America's thesis acknowledges this ghost in the machine. They argue that in an era of unprecedented money printing, where central bank balance sheets have exploded and national debts have soared, institutional investors are engaged in a silent search for monetary reinsurance. They are looking for assets that exist outside the banking system, that cannot be printed into existence. Gold has long played this role, but silver, they suggest, is the volatile, leveraged cousin. If the fear of currency debasement moves from a whisper to a roar, capital will flood into silver not just for its industrial use, but for its ancient role as a store of value. This pillar adds a rocket booster to the industrial story. It means demand could come from two completely different sources at once, factories and vaults. Pillar 3, the brittle supply chain. The third and final pillar is one of constraint. It asks a simple question: where will all this silver come from? Bank of America's research highlights a critical fact. Over 80% of silver is mined as a byproduct. It comes from digging for copper, lead, zinc, and gold. The decision to open or close a mine is not made based on the silver price, but on the price of these primary metals. For decades, silver prices were too low to justify dedicated mining. This led to chronic underinvestment. The pipeline for new, major silver mines is almost empty. It takes 10 to 15 years to bring a major discovery into production. Therefore, even if the price of silver doubles tomorrow, the physical supply cannot quickly respond. The supply line is inelastic. It cannot stretch to meet the surge of demand their first pillar predicts. For the business leader watching, this triad of arguments is formidable. It presents a closed logical loop. Unstoppable demand plus monetary panic plus unresponsive supply equals explosive price. But Marcus leans back in his chair in Zurich, his eyes narrowing. Every fortress, no matter how strong, has a critical vulnerability. Its greatest strength often contains the seed of its potential failure. The entire Bank of America doctrine is a bet on a specific, orderly, and fully funded version of the future. It assumes the green transition proceeds on schedule, without major political reversals. It assumes inflation fears remain contained enough to not crash the economy, but present enough to drive investors to hard assets. It is a bet on a perfect, linear progression. And the world, Marcus has learned over 30 years, is never linear. It is chaotic, reactive, and full of surprises. The real question now becomes clear. Did BNP Paribas spot a fatal crack in this fortress wall? Or are they simply shouting at an impregnable citadel, soon to be proven foolish? The challenge has been made. The doctrine has been laid bare. The move by BNP Paribas was not bearish in the conventional sense. A typical bear argues that a price is too high, that speculators are too excited. This was different. This was a direct strike at the foundational narrative. They were not just questioning the number on a chart. They were questioning the future Bank of America had so vividly sold to the market. Their primary weapon was not a complex economic model. It was a simple, powerful force that has governed business since its inception: price itself. The first cut, the knife of substitution. BNP's analysts presented a cold, engineering reality. Silver is excellent, but it is not magical, and it is not irreplaceable. When the price of any critical input rises too far, too fast, the entire machinery of global industry turns against it. Research and development budgets are redirected with urgent purpose. Scientists are tasked with a single mission: find a cheaper way. This is already happening. In photovoltaics, companies are developing techniques to use less silver paste per cell, a process called thrifting. In electronics, chemists are experimenting with advanced copper alloys and graphene-based inks. BNP's argument is that the very price spike Bank of America predicts will be its own undoing. It will activate a wave of innovation that will systematically reduce silver's role in the very technologies driving its demand. The demand curve, in their view, is not a straight line pointing up. It is a curve that will flatten and then bend downward under the weight of its own success. The second cut, the scissors of macroeconomic pressure. Here, BNP Paribas revealed its true strength as a European institution with a deep, often pessimistic, understanding of macroeconomics. They looked at the same green energy transition and saw not an orderly march, but a treacherous climb. Their model factors in what Bank of America's might underestimate: friction. The transition requires not just political will, but unimaginable amounts of capital. It requires stable supply chains for dozens of critical minerals. It requires consistent subsidy and consumer buy-in. What happens, BNP's logic asks, in a world of high interest rates, where financing for massive solar farms becomes prohibitively expensive? What happens during a global recession when governments, facing budget crises, delay or cancel green subsidies? What happens if political winds shift and the net zero timeline is pushed back by a decade? In this scenario, a low-pressure transition, the industrial demand for silver does not vanish, but it stutters. It comes in fits and starts. It fails to meet the explosive, smooth trajectory the bulls have priced in. BNP is betting on a messy, underfunded, politically fraught reality, not a clean, funded ideal. The hidden motive: a war of financial cultures. For Marcus, watching from the crossroads of Europe, this is the most fascinating layer. This is not just a bank being conservative. This is a clash of financial DNA. Bank of America, representative of the Anglo-American model, often displays a bias toward growth, disruption, and transformative narratives. They finance the future they want to see. BNP Paribas, a pillar of the continental European model, operates with a deeper-seated bias toward stability, risk mitigation, and the constraints of the present. They are guardians of capital in a fragile system. By issuing this forecast, BNP is positioning itself as the voice of sober reality in a room shouting about a golden, or silver, future. They are speaking directly to the conservative institutional money in Europe and beyond that is skeptical of hype. They are building trust not by promising riches, but by promising prudence. But this prudence carries a profound risk. If BNP is wrong, they are not just wrong on a trade. They have positioned themselves on the wrong side of history. They have bet against human ingenuity and political momentum. They have, in essence, declared that the future will be slower, poorer, and less innovative than the world hopes. The gambit is set. One bank bets on acceleration, the other on friction. We now have two maps of the future, two stories. But in high finance, stories are not told for entertainment. They are told for control. They are told to move capital, to shape policy, to build, or break, real-world empires. The public debate over a $100 price target is merely the surface ripple. Beneath it is a deep, cold current of institutional power, where the true war is always fought. The conflict between BNP Paribas and Bank of America is fascinating as a public disagreement. But to the seasoned observer in Zurich, the public fight is merely the theater. The real battle is happening elsewhere, in three silent, powerful realms that dictate the flow of global capital. This is the war for the underground river that feeds all markets. Every bank's primary product is not loans or trades, but trust. Institutional clients, sovereign wealth funds, pension giants, family offices allocate billions based on which institution's worldview they find most credible. This public clash is, in essence, a high-stakes marketing battle for the allegiance of that capital. Bank of America's narrative is one of inevitable transformation. It tells a story of a world physically rewiring itself, creating a can't-miss opportunity in the basic materials of that new grid. It is an optimistic, growth-oriented story that appeals to investors seeking to ride a megatrend. BNP Paribas' narrative is one of pragmatic constraint. It tells a story of economic gravity, technological pushback, and the harsh limits of political will. It is a defensive, risk-aware story that appeals to capital preservationists. Who wins this narrative war does not just influence silver prices. It directs which entire sectors receive investment. If Buffett's story wins, capital floods into mining ventures, green tech startups, and physical commodity funds. If BNP's story wins, capital stays cautious, waiting on the sidelines, or flows into efficiency technologies and substitutes. The war over the silver price is a proxy for a much larger fight over which vision of the 21st century economy gets funded. Few outside professional finance truly grasp the scale of the silver market that exists only on paper. For every ounce of physical silver in a vault, there exists a vast, layered web of derivatives, futures contracts, options, swaps. This paper market is many times larger than the physical one. It is where banks like BNP and B of A are not just commentators, but active players. Their public research is never just research. It is a signal to this paper universe. A bank's stated view can directly influence the derivatives positions of its massive client base, creating self-fulfilling price momentum in the short term. More critically, each bank likely has its own proprietary book of derivatives tied to silver. Their public stance may be a strategic hedge, a bluff, or an attempt to move the market in a direction favorable to their hidden positions. This is the chess game within the war. The public price target is a piece moved on the board to protect the king, or to set up a checkmate the audience cannot yet see. The third front, geopolitical and regulatory currents. Finally, Marcus sees the faint but unmistakable shadow of geopolitical alignment. Bank of America is a cornerstone of the U.S. financial system, a system that benefits from dynamic, disruptive growth and the dominance of the dollar. A narrative of resource scarcity in the energy transition can justify certain policies, domestic mining initiatives, strategic stockpiles, trade terms favorable to allied nations. BNP Paribas is a champion of the European financial system, which is more immediately exposed to energy insecurity and is often more cautious about raw commodity inflation. A narrative of efficiency and substitution aligns with European strengths in high-tech engineering and a regulatory environment deeply cautious of speculative bubbles. Thus, this is not just a bank versus bank conflict. It is a minor front in a larger, quiet struggle between Atlantic financial philosophies. It is a battle over who sets the rules for the next economy, those who control the resources, or those who control the technology to use them sparingly. For the entrepreneur, this is the critical lesson. The $100 war is a live sensor reading. It tells you that the system is uncertain about a fundamental input cost. It tells you that powerful actors are positioning themselves for different outcomes. Your supply chain, your business plan, your very market may lie downstream from this hidden conflict. We have mapped the battlefields. We have studied the fortresses and the gambits. We have followed the war into the silent depths where capital and power flow. Now, we arrive at the only question that matters for a person in business. What do you do? This is not about choosing a side in a bank war. It is about learning to navigate the world this war reveals. The conflict between BNP Paribas and Bank of America will not be resolved on a screen with flashing prices. It will be resolved over years, in the quiet of boardrooms, at mining sites, in government halls, and in R&D labs. The winner will be the institution whose underlying assumptions about our decade prove more accurate. For Marcus, watching from Zurich, the profound lesson is not in the answer, but in the confrontation itself. This public fracture is a rare diagnostic tool. It shows us the major fault lines in the global economic consensus. Your strategy must now account for this seismic uncertainty. Implication 1. For the business leader, stress test your world. If your enterprise touches manufacturing, technology, or energy, silver is not an abstract concept. It is a potential point of extreme volatility in your input costs. You can no longer rely on a single forecast. You must engage in a disciplined exercise. Build 2 simple scenarios. Scenario A. The B of A world. Resource scarcity is real. Input costs for key components, solar cells, advanced electronics, rise persistently and structurally. Your strategic response must focus on securing supply. This means long-term supplier contracts, investing in recycling loops for your products, or exploring direct investments in material science to control your destiny. Scenario B. The BNP world. Technology and substitution win. The cost pressure eases, but competition shifts to efficiency and innovation. Your strategic response must focus on R&D agility, designing products that can easily adapt to new materials and forming partnerships with firms leading the charge in alternatives. The point is not to predict which is right. The point is to have a plan for both. The company that does this is not betting on silver. It is betting on its own resilience. The conflict between BNP Paribas and Bank of America will not be resolved on a screen with flashing prices. It will be resolved over years, in the quiet of boardrooms, at mining sites, in government halls, and in R&D labs. The winner will be the institution whose underlying assumptions about our decade prove more accurate. For Marcus, watching from Zurich, the profound lesson is not in the answer, but in the confrontation itself. This public fracture is a rare diagnostic tool. It shows us the major fault lines in the global economic consensus. Your strategy must now account for this seismic uncertainty. Implication 1. For the business leader, stress test your world. If your enterprise touches manufacturing, technology, or energy, silver is not an abstract concept. It is a potential point of extreme volatility in your input costs. You can no longer rely on a single forecast. You must engage in a disciplined exercise. Build 2 simple scenarios. Scenario A. The B of A world. Resource scarcity is real. Input costs for key components, solar cells, advanced electronics, rise persistently and structurally. Your strategic response must focus on securing supply. This means long-term supplier contracts, investing in recycling loops for your products, or exploring direct investments in material science to control your destiny. Scenario B. The BNP world. Technology and substitution win. The cost pressure eases, but competition shifts to efficiency and innovation. Your strategic response must focus on R&D agility, designing products that can easily adapt to new materials and forming partnerships with firms leading the charge in alternatives. The point is not to predict which is right. The point is to have a plan for both. The company that does this is not betting on silver. It is betting on its own resilience.